And we are officially recording. And with that, welcome once again to this morning's session. I am your host, Jeff Christie, and we will be spending our probably the next 20 to 30 minutes talking about this topic, and I'll explain the topic in a moment. Some of you may have been logging in expecting to hear from ACCG's Legislative Director, Clint Mueller. And Clint sends his apologies and regrets. Clint was called to the Capitol for a meeting on local option sales tax with House Majority Leader Burns. And so I have been charged with the enviable task of hosting this morning's webinar. So Clint sends his regrets, but he's been very close to this issue all along. And certainly anything that comes about as a result of today's webinar, I will discuss with Clint. And if we need to get back to anybody, we absolutely will. I would also like to introduce virtually two panelists or two guests who are joining us on the webinar. We've got Kevin Hagler with us this morning. Kevin, I appreciate you being on. Kevin is the Commissioner of the Georgia Department of Banking and Finance. I've been in several meetings with Kevin and also with Kevin's coworker, Bo Fears, and Bo's also with us this morning. Bo's the Deputy Commissioner for Legal Affairs at the Department of Banking. And I really appreciate them being here, and I have given them free rein and permission to jump in at any time if they have something to contribute, or more likely something that I say that they need to correct. I invite them to do that. So with that, we're going to get started. You can see on your screen, I had to rehearse how to say this, but we are going to spend a few minutes this morning discussing this topic of multi-bank cross-guarantee collateralization pools for depositors of public funds. And if that hasn't put you to sleep yet, I hope to keep you awake the rest of the time. We are talking about this topic this morning because there is legislation that has been introduced in the Georgia General Assembly. So my goal this morning will be to give you a little bit of history of how we got to this place, what is this place, and then moving forward, how we might make a recommendation to our ACCG Policy Council. But the purpose of this morning was to gather some finance directors and those who handle these public funds on a day-to-day basis on behalf of counties, so that we can introduce y'all to this topic and then get your feedback and help us understand what we need to know, questions we need to ask. So to get started, what I'd like to do is share a little story with you, kind of real quickly, about how this came about, and then we'll get into the meat and potatoes. So a couple of months ago, there was a small county that contacted us and said that their community bank, where they deposited all their county funds, had asked them or informed them that they were going to a single bank pooled risk collateralization method for public funds, and they asked the county to just acknowledge that the bank was participating in that and to sign off on it. And we had a finance director who actually read those two one-page memos from the Office of the State Treasurer and was slightly alarmed by something that was in that memorandum of agreement. And ultimately, the county decided that they did not want to sign off on it. And long story short, a week later, the vice president from the bank showed up at the county commissioner's office with a check, handed it to the finance director, and said, "We've appreciated the relationship we've had with you over the last X number of years, but all of your accounts are now closed. And here is a check for all of your remaining balances." And as you can only imagine, that threw the county into quite the state of disarray, burned some bridges, a lot of checks bounced, and there was just a lot of egg on a lot of faces, and it was not a good story. Switching ends of the spectrum, this could potentially have effects in large counties as well. And we're going to get into a little bit later why that could easily have happened in a large county as well. But hopefully by the end of our time together, we've got a solution that everybody can live with and everybody understands should be ultimately a win-win-win situation for everybody involved. So based on that story that I shared with you, the Georgia Bankers Association has been monitoring this topic since November, and they have basically mobilized and have been working with all of the important players almost 24 hours a day, 7 days a week on this topic to come up with a solution. So that's what we're going to talk about today. So this began a couple of weeks ago on January the 5th. Clint Mueller and I attended a presentation at the Georgia Bankers Association offices, and all of the players were there, from the state treasurer to the Department of Banking and Finance to representatives from some of the bigger banks in Georgia, as well as representatives from GMA, ACCG, the Georgia School Board Association, just so we could get it firsthand from Joe Brannon, the executive director there, and have a little Q&A session of our own. So Joe brought us a 29-slide presentation, the title slide of which you are looking at on your computers. And I would characterize the presentation that the Bankers Association made to us as having taken place somewhere around the 500-foot, maybe the 1,000-foot level, as in a grotesque amount of detail that I'm sure a lot of the financial and bank folks understood, but a lot of detail that probably was not relevant or necessary to those who are depositors of public funds, i.e. counties, cities, school boards, etc. So what I did was I took that presentation that Joe Brannon shared with us, went through it yesterday and edited out some of the slides that were that grotesque level of detail. And I'm going to try this morning to keep us 40 to 50,000 feet, just trying to hit the highlights. I will skip over some things because I couldn't get them out of the slides. But again, we'll have time for some interactive question and answer as we go through. So this title slide shows you in the lower left corner that the topic of that presentation 3 weeks ago was protecting public deposits in the post-Basel III era. And so I was already confused because I didn't even know what the post-Basel III era was. And basically what I now know and what you need to know is that Basel III is a series of banking regulations that come down from the federal government. Banks have no choice but to follow them. And all of these Basel Roman numeral 3 requirements came about as a result of the 4 to 5 year recession that we've all gone through this decade and are now emerging from. So it was characterized for us that these Basel III components were a game changer for the largest financial institutions in Georgia. And let me stop right there. When we talk about these large banks, there are 10 banks in Georgia that qualify for the title of large banks. And they had some new requirements put on them by the federal government in these Basel III components that you see listed in front of you. How much did they have adequate capital on hand to collateralize publicly deposited funds? In fact, all of their funds. Could they pass the stress testing requirements? And in the event of a horrific market crash, could they survive that crash? And would they meet the market liquidity risk that was now being considered by these Basel III requirements? So ultimately, what all that means is when we talk about these larger financial institutions, the way Georgia looks at it is any bank that holds over $50 billion in assets qualifies as one of these large banks, and they're called LCR banks. And that's probably, you'll see I just wanted to say that because you will see a reference to LCR banks, and when you see that, you can just in your head, in your mind, translate to big banks. And when we're talking about the big banks, we're talking about the SunTrusts and the Regions and those. And you'll see a list later on in the presentation of who those big banks are. There are 10 of these in Georgia. And this LCR formula that applies to those big banks is a couple of the slides that I deleted because the formula is not important and it is amazingly complicated. So why we're gathered here today is because counties, in the context of this topic, join with cities, local boards of education, local government authorities. All of these are captured by the title Depositors of Public Funds. And there are about 3,000 depositors of public funds in Georgia. And so there is obviously a vested interest in this topic. Currently, the way that depositors of public funds, the way that those deposits are handled in Georgia, when a bank accepts a deposit of public funds, they must collateralize those funds at a level of 110%. And those requirements have been enforced for quite some time. What we're going to see is that these new banking regulations are going to require a much higher level of collateralization. They already do require that higher level. And so this multi-bank pool is a response, and we're going to talk our way through that. Right now, about 65% of all deposits in Georgia, public and private, are on deposit with those Big 10 banks. And that number is probably even higher if you just break out the publicly deposited funds. It's probably even higher than that. So this solution that we're going to talk about today is in response to that. This next slide again shows you the LCR definition, if you will. What I wanted to draw your attention to is what kind of an effect will these new regulations have? For those 10 big banks that are now going to have to collateralize at a level higher than 110% or greater than 110%, it may no longer be practical for those banks to accept publicly deposited funds, and they may get out of that space. And that would be a big risk. And let me take you down to the last bullet on this slide, because if those Big 10 LCR banks get out of this space, it's going to be those depository relationships would now be made available to the smaller banks, but they're going to have even less capacity than they do now to absorb those inflows. So it doesn't paint a very pretty picture. And then I'm going to bounce up to the bullet above that. So ultimately what it means for depositors of public funds is there's going to be fewer choices out there for developing your relationship. And I want to go back to the story that I opened with. That small county who had their accounts closed immediately, quite obviously, went searching for a bank with whom to develop a depository relationship, and they found out very quickly that there was not a single bank anywhere that would take on their deposits. And ultimately, what they were faced with was the choice to spread their deposits out at approximately 10 different financial institutions. And those of you that are in the business of handling county funds realize what a nightmare that would be, to have to do your banking with 10 different institutions. There just would be no capacity there for relationship development, and the paperwork and the legwork that would go along with that would just be absolutely something that I don't know of a county anywhere that could handle. So these new requirements, these new Basel III requirements, as you see on this slide, do have a huge effect on public depositors. Let's look at it just quickly from the bank's perspective. And there are two bullets there that I did not put in boldface type because those are technical concerns for the big banks. But the third bullet down that I did bold shows you where this potential problem comes from, keeping in mind that those 10 LCR banks are probably holding 60 to 70% of publicly deposited funds. And now these banks have a reduced preference to hold those funds and to have those relationships with local governments and everybody else who publicly deposits funds. So that is kind of the backstory. That's what brought us to where we are now. And so I think this slide does a great job of capturing the needs of everybody who's a player in the game. For counties, cities, and boards of ed, and everybody else who's a depositor of local funds, what you all need above all else is an assurance from your financial institution that your deposits are going to be protected, and protected at all times, obviously, but especially were we to get into a financial crisis, as we have seen in the last 6 to 8 years, you need absolute assurance that your deposits are going to be protected there. From the bank's perspective, what they need is an option to avoid this 130, 140, 150% collateralization requirement that is really impractical, and it ties up their liquid assets if they have to use them for collateral, and that's not very palatable to them. So it brings us around to how can we solve this? How can we create a solution that's a win-win for everybody? And the answer is this multi-bank pledging pool. And let me pause right there to just let you know, you'll see a list of states in a few minutes. States all around us, from Florida to Alabama to North Carolina to Virginia, all of those states are already doing this. So I think ultimately, at the end of the day, this is Georgia catching up to something that other states have already figured out. And the people that have been involved in creating this solution have taken a very close look at the Florida model and at the Virginia model, if I remember correctly, and have kind of cherry picked the best aspects of several different models and are pulling it together to propose a multi-bank pledging pool for the state of Georgia. So let's look at that pledging pool and talk about some really key characteristics. Number one, it is a response to the marketplace realities of the day and of these new federal banking requirements. Ultimately, if you think about this multi-bank pledging pool, kind of like with respect to what we do at ACCG, helping counties to insure their workers' comp, their health care coverage, their property and liability, you take the risk and you pool the risk from a number of counties and you spread that risk out. This multi-bank pledging pool is essentially doing the same thing, such that no one bank is now on the hook for any one set of deposits, but yet they get to cover each other. And the very fact that the big banks in Georgia have all been consulted on this, and they obviously, with assets of over $50 billion each in the game, if they have all agreed to this, which they have, then you can now see that this is a good solution. If they're willing to expose their assets or to pledge their assets, if SunTrust is going to back Regions, then that can be a good thing. And what this now does is open the door for smaller banks and lots of community banks to join this pool and potentially to be contingently liable for losses at any one bank. So again, there's your list of states that are already doing this. A lot of those are our neighbors, and I give a lot of credit to the folks that have been involved in this in Georgia, having done their homework and their research to look at these multi-bank pools. So the benefits to public depositors, there's a list there, and I'm not going to read through those. Those are there for you to kind of look and see and read through. Probably most importantly is there will be oversight of this process through the Office of the State Treasurer. There will be oversight of this process from the Department of Banking and Finance. The Georgia Bankers Association will be involved on a daily basis, which, as I understand it, most banks are actually examined every anywhere from 6 to 12 to 18 months. And this brings us into an accountability where banks are going to be looked at monthly and in some cases daily. So that should be a great level of comfort to our public depositors. The banks benefit from this pool. Again, there's a list of reasons. I'm not going to read them. You can print this out, look at it later. But the banks are pleased with this solution because they do not have as many of their assets tied up in collateralizing public deposits. They can now use those assets for other things like lending and ultimately making money, which is what banks are in the business to do. Okay, the next slide is going to take a look at what's different. And currently, this is something that I learned. There is actually an opportunity for banks in the current atmosphere to, when they collateralize funds, they can do it one of two ways. They can do it dedicated collateralization. And like I said earlier, currently they have to collateralize those deposits at 110%. And the new Basel III requirements are going to require them to collateralize at 150%. But then they still have that option. They can also do a pooled risk method. It's a single bank, but they can take all their depositors of public funds and collateralize those funds together in a single bank pool. And there are currently in the state of Georgia 19 banks that that collateralize publicly deposited funds that way. And that will still be an option even if this multi-bank pledging pool is approved and becomes law. But I would hazard a guess that most of the banks that are currently in that single bank pledging pool would migrate over this multi-bank pledging pool. It seems like to me as if it would only make sense to do that. So that was what was different for public depositors. Here's what's different for banks. They've got increased liability to cover losses. There is going to be more reporting, and I'm sure that the banks are not in love with that. But the good news is, and we're going to see this in a slide, in a couple slides, there will be much increased transparency for this process, and it will actually be a publicly viewable document that will be out there on a website, and anybody could essentially look at it. So this next slide is the collateralization options, and I wanted to just mention a couple of things here. Number one is up there, and that's kind of a summary of what I just said. These dedicated method and the bank level pool will remain as options. Number two is actually, I'm going to skip down to number three for a minute. These banks that are qualified who have assets in excess of 50 billion, those are the big banks, those are the LCR banks, those are the big 10 in Georgia. They will be required to participate in this multi-bank pool. And they, like I said earlier, have all agreed and they're on board with this. Going back up to the second bullet, there are, I believe, approximately 180 other banks that have assets of less than 50 billion. So I'm calling those in parentheses the small banks. They will have the option to join this multi-bank pool. Again, my strong suspicion is that they would choose to do so because the risk is now being spread across the pool, and it's not just on that one bank. So this looks like a solution that a lot of banks would join. And I believe that the banks that are currently participating in the 19 banks that are currently participating in that bullet number one, the dedicated or the bank level pool, would migrate over to this option as well. So the next slide, finally, and if I could have moved it around, I would have, shows you those LCR banks, the 10 big banks in Georgia. With assets in excess of 50 billion, and they will all be a part of this multi-bank pool as required by law. You saw a term 2 slides ago that referenced qualified banks, and I'm going to take a minute, and this may be where Kevin jumps in, and I don't want to get too deep in the weeds here, but basically all banks are continually monitored and rated for their, let's just call it their financial health status. And basically what this says is that if a bank is qualified and as healthy, they will be allowed into the pool, and they will have a collateralization requirement placed on them that is based on their financial health. If they're an extremely high performing bank, a well performing bank, they will have a lower collateralization requirement. And somewhere in my notes, I had a note, I think that there are most of the banks in Georgia would qualify here, and that the vast majority of banks, there are 241 banks operating in Georgia as of January 4th, as a matter of fact. 184 of Georgia's banks would be eligible to participate in this multi-bank pool if it went into effect right away. Only 16 banks, because of their lack of financial health, only 16 banks would be ineligible to participate if this went into effect today. And then there's a small group in the middle of 41 banks that would have to demonstrate their commitment to getting healthier. And so there's 41 banks that would be on the fence. So the vast majority of banks, that number of 184, would be eligible to participate. And there's a lot more information available for those of you that would want to know a little bit more about how banks would be measured and how they would be assessed. And I'm going to go ahead and pledge to you that I can share that with you later, but for today's purposes, it's not overly necessary. I'm going to flip slides now and show you that I said I wasn't going to show you, but the collateralization percentages, you can see there how Florida has set their tiers. And those numbers that you see in the left-hand column of the three tiers, the 0 to 29, the 30 to 69, and the 70 and above, are measurements of financial health that banks, they get rated and put on this scale. 0 to 29 would be a bank that was not very well performing, would be rated lowly, and therefore would have a very high collateralization requirement at 125% in the multi-bank pool. Those that are the median, 30 to 69, which represents the vast majority of Georgia banks. In fact, I think I heard that if this went into effect today, that all of Georgia's banks would be rated at that 50% collateralization requirement level. And there might be a small handful of extremely high performing banks, very healthy banks, rated at 70 and above. And if you were that bank, or if you were banking with that bank, their collateralization requirement would be a very small 25%. But yeah, that last line says that using the ratings, that all 10 of the LGR banks, the big banks, would pledge at the 50% level. So that's it's a good indicator for Georgia banks. And again, that's probably too deep in the weeds. But it is important to note on this slide that the State Depository Board, working with the Treasurer, would have the authority to set these collateralization requirements on a periodic basis, and could also go up to 125% requirement if the economic conditions warranted. And I know that Kevin Hagler is he's on the call with us. He is a member of the State Depository Board, and so if I've misspoken anything about that from this level, I welcome Kevin to jump in and correct me. I told you there was going to be increased transparency in the process, and that these financial institutions will be regularly reviewed. There will be monthly reporting on these banks. Those reports will be pulled together from the 241 separate banks, consolidated into a single report. All the depositors, I'm sorry, I misspoke when I said all 241 banks would be included. All the banks who choose to participate in the multi-bank pledging pool, they will be reviewed periodically, consolidated into a single report, and this report would be shared with all the depositories that were members of the multi-bank pledging pool, and it would be posted to a website where it could be inspected at any point in time by anybody who was a member of the pool. So that, to the best of my knowledge, is Jeff Christie's ACCG interpretation of what is a multi-bank pledging pool, how would it benefit the depositors of public funds, how would it benefit the banks, how would banks have an option to join, or why would they want to join or not join. And now I want to take just a quick glimpse, and I also want to, before we talk about the legislation outright, I do want to let you know, I believe in your control panel on your screen, there's an option for you to click on a tab called a Handouts tab. And one of the handouts located there is a copy of the draft legislation. And for county finance directors, we encourage you, we ask you, if you will, to print out that proposed legislation and review it. Talk to your county elected officials if you would like to review it with them. And we ask you, if you have concerns or questions about that legislation, to communicate those with us here at ACCG. There's actually, I'm not sure if I have the term right, I believe this legislation has already been introduced in the General Assembly. Tomorrow, it gets its first hearing, if I've got the right word. It will be discussed tomorrow in committee, and ACCG will be present. The Georgia Bankers Association will be present, and we'll have an opportunity to hear from legislators, their questions or their reaction to this. Essentially, looking at the slide, the legislation that is proposed, number one, will establish this multi-bank pool in the state of Georgia. Number two, it will authorize all the qualified banks to participate. It will require the large banks, the LCR banks, it will require all 10 of those to participate. It will, as we have discussed, establish the contingent liability for all those who participate, relieving them of their current requirements under Basel III to collateralize publicly deposited funds at 150%, most of which that's just undesirable for so many reasons. The legislation will empower the State Depository Board to enact rulemaking about how often these institutions are reviewed, who's participating, who needs to have their collateralization requirements changed, either due to financial health or due to economic conditions. And the last bullet is the self-professed and self-confessed most difficult. In talking with Joe Brannon at the Bankers Association, determining an effective date is going to be tricky with regards to getting it in the legislation. It will probably become a rolling implementation date. And if Kevin or anybody else wants to address that, I know that they are working with the LCR banks to figure out how and when this will be become effective, and I will probably learn more about that tomorrow at the hearing. But ultimately, that is probably the biggest uncertainty at this point. But we will follow up with our members with respect to if this legislation passes and how it will be enacted and when it will be enacted. And I think I probably have either talked myself to death or painted myself into some corners. And at this point, F is here in the office with me, and I see that there are a couple of questions out there. And again, if you want to type I'm going to ask you, if you will, if you can concisely type your question, that would be a tremendous advantage for a number of reasons. Number one, we will be able to retain a copy of that question, and if we haven't been able to answer it articulately, we can go seek an appropriate answer and make sure that we communicate the answer to your question. Number two, because this webinar is being recorded, others who might view this at a later time in an archived format may well have the same question that you do. And if they see that you have typed the question and it has been answered, then they'll have their answer. So I'm going to just give everybody a few minutes to decompress. If you have a question, you want to type it. Kevin and Bo from the Georgia Department of Banking and Finance, I would invite you all at this point to jump in, add anything that might need to be added, or correct any missteps that I might have made. Any suggestions, Kevin or Bo?
Jeff, this is Kevin, and to the group, thank you for inviting me to participate today. Jeff, I thought you did a fantastic job of running through the concepts and the story that goes behind this. I'm a little worried about job security, since you were able to absorb that from one presentation at the GBA and really tell it, I think, better than the GBA did, to be quite honest with you. I was going to ask Bo Fears, who is our general counsel here, who's worked on this project and continues to work on it in terms of the wordsmithing and development of the legislation. I think he can give everybody a quick update on the effective date issue that, as you mentioned, is fairly complicated.
All right, yes, thank you, Kevin and Bo. I'll look forward personally to you providing a little clarification.
Sure. So, as I understand it, there will be an amendment proposed tomorrow, and what it's going to do is, the concern is that if the legislation went effective either upon the signature of the governor or on July 1, whatever your typical effective date language, that if the systems weren't in place, the regs or the policies and procedures, and basically the multi-bank pool, if it wasn't ready to go, if that law was effective, then essentially these LCR banks, because it is mandatory that they participate in the multi-bank pool, that they would no longer be able to take public deposits after that effective date, which is potentially a horrible outcome. So what the proposed change is going to be is, and now I might be getting into too much detail, I apologize, but there's going to be a definitional change where it's going to permit the LCR banks to participate in both the single bank method or the multi-bank method until either July 1, 2017, which will be more than enough time to get the multi-bank pool in place, or until the policies and procedures are established by the State Depository Board and implemented by the Treasurer. So whichever event comes first, that'll happen, and then the switch will be flipped on the multi-bank pool. So that will should provide more than adequate coverage and avoid a potentially major problem in the event we had an earlier or a typical effective date and weren't able to have everything in place.
Okay, so it sounds like, just based on the amendment that will be presented tomorrow and the way that you all as ACCG members have nearly constant access to legislation that we are tracking and reviewing. You can look at our website, you can look in the policy section of our website, and you can find a summary of this legislation that's a little bit more in layman terms. And anytime the legislation is updated or it gets voted on in committee or in subcommittee, and now it's going to full committee, you can track all of that on a daily basis. Our legal team is updating that website probably 20 times a day. So you can track this legislation that way. And certainly for those on the call, we will follow up with you all as progress is made on the legislation, and especially with regards to the effective date that Bo just talked about. So what I would like to do on our end, we can see a couple of the questions that have been asked. I'm going to read the question aloud so that everybody who's on the webinar can hear the question. If I know how to answer it or can take a stab at it, I will. And I will also invite, again, Kevin and Bo from the Department of Banking and Finance to jump in and with their knowledge. And Kevin, I want to go back and revisit that topic of job security real quickly. You don't have a worry in the world, my friend. So a question that came up, the first question that we got says this: what guarantees would the pool provide for the public depositors? And I'm going to take a stab at it and say that this is life, and there are no ironclad, rock solid guarantees. I will add to that, as I shouldn't probably put in a wisecrack response, that the guarantee that public depositors are exposed to, what they have now is they have much greater risk aversion, because they now have the pooled assets of all the banks participating in the multi-bank pool, such that, let me just put it in terms of a scenario. Let's say that a county has its deposits with a community bank, and for some economic reason, that community bank begins to fail. Number one, the health of that bank is being monitored much more closely and much more regularly than it would have been before. Number two, if that bank were to, let's say, collapse, they now, the funds that are on deposit with that bank are now collateralized by the multi-bank pool, not just by that single bank. So I would think that depositors of public funds would ultimately have a much higher level of comfort operating in a multi-bank environment, a multi-bank pool environment, than they would in a single bank environment. And Kevin and Bo, I'll ask you to add anything that you might to that response.
Absolutely. I think you characterized it very well. Just to clarify, that when you talk about banking, it's a world of risk mediation, risk monitoring. It's not a world of risk elimination. So there's always inherent risk in everything that a bank does. And I know that translates into the world that everyone on the phone operates in also. What we typically see is in the dedicated method, where you may have $1.5 million or so on deposit in a small community bank, and the community bank will then pledge 110% of securities against that. That generally works very well. There are a few gaps there, though, in that, when I examine those banks, my staff does, that can occur, as Jeff had mentioned, 6 months, 12 months, 18 months on a cycle. And, we may or may not we typically do look at that function, but there's a possibility it could be risk scoped out. And also, that's a point in time analysis. And I know your deposits come and go at different times of the year. So if we come in the middle of the summer, that may not line up with when your big tax hit is. And so maybe they don't have any public funds that day that we're there. So we may not be looking at that at all. We rotate our exams with a federal counterpart, typically the FDIC, sometimes it's the Federal Reserve. They don't typically look at this issue at all. So I don't want to scare you away from using the dedicated method, but just know that it's not closely scrutinized, and there's always just simple clerical issues, or the safekeeper could have the wrong security pledged or to the wrong account. That there's always those technicalities. So and a lot of those issues are kind of similar when you look at the single bank pooling method. It's a little bit cleaner in that they're putting in all those deposits and putting in a pool of securities, all from the same bank, though. And you do have the GBA and treasurer also kind of looking over that to help tidy it up a bit. But you do run the risk of a catastrophic event happening. Those securities could drop suddenly in value at the same time and leave a gap there. Contrast that with the multi-bank pool, whereas, again, Jeff's done a great job of mentioning that we're going to have the 10 largest banks that operate in the state, and that list was up there. Know that some of those are in the $1 trillion category. SunTrust is the largest one that I regulate directly at 200 or 180 or so billion dollars in total assets. But some of those banks on the list are considerably larger, and there's always that argument that they are so large that they might not be allowed to fail, despite what Congress is currently doing to try to say that they can. So you're getting this guarantee of 10 extremely large banks that are extremely valuable to the economy and to all of us together. The odds of any of those failing is quite remote. the fact that they're joint and severally liable means that if something bad happens, that they can pick up the slack there. And it won't be 100% exposure. I think looking at what the Florida current levels are, and we'll need to set those in Georgia, but assuming that we use something similar, which I think is a fairly good assumption, those banks will be operating at a 50% capital ratios or pledging requirement. So you would have 50% pledged against securely, but then you have literally billions of dollars worth of capital also securing them by the banks that are not, failing or troubled. Also, we try to avoid that situation completely, and that's why there's those tiers. If a bank, typically when a bank fails or gets into trouble, it's a gradual over time possibility. It could happen overnight, but it's far more common that it's something that happens over time. What ideally would happen would be if one of those large banks was to experience trouble, we would, because their rating would drop, we would increase their collateralization level to 125%, which, again, if they're having to put 40% over for the LCR requirements of Basel III, puts them at 165. They're going to quickly divest of the public funds. It'll be a major money loser for them to hang on to them. Now, that would cause some inconvenience, but they will quickly be encouraged to move them to more solid banks that could take them. So I think what would most likely happen is that if a large bank was struggling, the level of public funds that it held would probably either be completely gone or be much reduced by the time it got there. And then also, again, you'd have this major backstop of the multi-bank pool of the participants out there. And that's another thing that Jeff was talking about as far as the smaller banks. If this turns out to be the best way to do business, we wanted to make sure that they were able to, but we didn't want them to bring in additional risk into that pool. That's why they have to be basically in strong financial or good financial condition to be able to get into the pool at the first place. And then we would apply those pledging levels to them, which would, if they started to deteriorate, again, the pledging requirements go up so high that it really encourages them to go back to a dedicated method and to get out of the pool. And one last thing I'll say, just because I'm starting to ramble on, is, again, we borrowed heavily, and by heavily I mean cut and paste almost, from the Florida model, and know that there were no problems in the Florida model. It performed as expected. They had at least a bank fail that was in that pool. Theirs, I think, requires more than just these really large banks to be in it. One of those failed. It was not a problem. And keep in mind, too, a lot of times when banks fail, the vast majority of the time when a bank fails, the deposits and assets move on to another bank. So you don't even have this liquidation scenario. So that's very unique, and even was very unique in Georgia, that you actually have a payout scenario, which is what you're trying to avoid here. So again, there's another layer of why that's not very likely to happen. But again, Florida, they had one, this has been in place for a very long time. They went through the Great Recession. They were hit almost as hard as Georgia, very close to hit as hard as Georgia. I think one bank failed, had a payout situation. The other banks quickly paid it up, and it worked. So it's been tested in the Great Recession, which in our analysis, the Great Recession hit Georgia and Florida harder than the actual Depression did, just for comparison. So I say that in that, again, there's no guarantees of zero risk, but in all honesty, again, I know I regulate banks, but I'm also on the State Depository Board, so I am looking out for your interest too, so I'm kind of straddled there. I feel very comfortable that the multi-bank pool is the safer option, given all three options, to be quite candid with you.
Well, Kevin, number one, thank you for not only that response, but ultimately what you did was you answered several other questions that we've got coming up. I do want to go back on that first question and give credit to David Gruen from Forsyth County for bringing that one up. And hopefully what I took away from what Kevin just said for the last few minutes, ultimately his last sentence was the most important to me, from where he sits as a regulator and a member of the State Depository Board. His level of comfort with this solution ultimately leaves me, on behalf of Georgia's counties, feeling very comfortable about this potential solution that, again, I will categorize as a win-win. Barry Holland from Houston County had asked our second question, and I think Kevin answered it. The question was, what would happen if your government has accounts at ABC Bank, and then ABC Bank was in the pool of banks, and then it failed? And I think Kevin's reply to our first question certainly covered that one. And Barry, I hope that you are satisfied with that answer and now know that multi-bank pool would be in place as a buffer for ABC Bank were it to fail.
Jeff, if I could augment that just slightly with what I said before, in that scenario, if you're with ABC Bank and it fails in the dedicated method, you're now negotiating with the FDIC to get the collateral. I think the collateral has been sent to you, and then it's up to you to liquidate it and make yourself whole. And again, if those security values have declined or something, you've got some exposure there. Again, I'm not trying to scare people off from the dedicated method because you've got a great advantage over corporate depositors who don't have that at all. But in the multi-bank pool, that bank fails, the others pass a hat, pay you off, you're done. You're good to go.
Excellent. That, Kevin, thank you, and should also again provide hopefully another layer of comfort for depositors of public funds as they consider this scenario. We have a third question here from Denise Brown, and Kevin, I may have to have you jump in here. Very simply, the question is, when are the Basel III requirements effective for banks, requiring them to perform at the 150% collateralization requirement? Is that not already in effect, Kevin?
That's correct. Those came into effect on January 1st. Basel III is an international standard that's supposed to go out to all the developed countries and those that participate in it. The U.S. federal government has elected to adopt it January 1st. And also, Basel III allows for a phase-in period over, I think, 5 years. The U.S. has truncated that down to 2 years. So it's a far more aggressive implementation. And so this is something that we need to resolve today. As far as the impact, maybe 80% today or 90% as opposed to 100% impact, but it's we're not in the U.S. taking a slow walk into Basel III. It is a very rapid adoption, and again, it's in effect right now. So the urgency is certainly there.
All right, thank you, Kevin. And Denise, to acknowledge the second part of your question, Denise also asked, how can we print this presentation? And we've already sent Denise a response, but so that all of you know, on your control panel on your webinar software, you should see a pane called Handouts, where I pointed out that the proposed legislation was there. Also in that handout section is not a copy of this presentation that you saw, but actually the full presentation, which I think was 29 slides, as was delivered to us from the Georgia Bankers Association. And the major difference between that presentation that is in the handout section and the one that I showed you today is I simply removed a few of the slides that provided a level of detail even greater than what we viewed today on the webinar. So you should be able to print that from that section. If for any reason you have difficulty downloading and or printing that, before we exit this webinar, I will share with you my contact information, and you are openly invited to send me an email and say, hey, Jeff, may I have a copy of that presentation? I'll send it straight to you. So that is not a problem. Kevin, this one may be one for you as well. We have a question, another question from Barry down in Houston County. And Barry's question is, will there be a charge or an additional cost to government accounts due to this change? If I assume that what Barry's saying is if the pooled banking method, the multi-bank pool, becomes successfully passed legislation, will there be any additional costs? And will banks now begin to charge fees for holding government accounts? Kevin, I'm not sure if you can answer that or not, but that's a two-pronged question from our friend Barry Holland in Houston County.
It is my understanding that there will be no direct cost passed along to public depositors as a function of this multi-bank pool being created. I would also, and this is more speculative on my part, but by reducing that collateralization level and allowing banks to then invest those funds into the lending function, which is far more profitable than the purchasing of securities that barely have any earnings potential at all, particularly in these days, that should, I guess, create some relief earnings-wise, financially for the institution. So there, I would think that the natural incentive there would be to make it so that it's less expensive to do that type of business. So it should be less likely to pass along fees.
Okay, and I certainly appreciate that. Two more questions.
I don't want to overpromise, but you may be able to earn more by going through those. At least there's more room to negotiate than there currently would be.
And that should be, in most counties' cases, a good thing. So I think our next question is probably a question that would be on the mind of every public depositor, especially counties. And this question, I'm going to read it first. How often will the pooled collateral be adjusted due to deposits or withdrawals? And the qualifier to that, Kevin, is in November each year. And this is true for this county and many, many others. November of each year, we deposit millions of dollars, as in 30 million or more, in a short period of time due to property taxes collections coming in. Counties need assurance that those deposits are properly collateralized. Could that be a concern to governments under the assuming that this legislation is passed and the multi-bank pool is adopted? Is there any concern with those spikes in the deposits of public funds, especially from the collection of county property taxes? That was a question that came to us from Gary Burkhalter. And Kevin, I'm going to lob it out there and just ask you, are there any concerns, or with these spikes in property tax collections, is there a relative assurance that those deposits would be properly collateralized?
Again, I think that situation improves under the multi-bank cross-guarantee process. The dedicated method, if I'm shooting from memory, currently allows for 10 days to collateralize those deposits. The multi-bank, as proposed legislatively, that's 1 or 2 days.
And I think, and this is both, the single bank pool method is 2 days, is what they do as well. And the idea is, obviously the depository board has to propose policies and procedures, but the treasurer is going to recommend, I believe as well, that it be 2 days. It's got to be fully collateralized. So you've got, as Kevin said, the dedicated method is 10 days. So you have more protection under the pooled method, and it's going to be the same under the single bank or the multi-bank pool.
Now that said, as I'm sure you do, if you've got millions of dollars coming in a very short time frame, be sure your bank knows about that.
Good, and that is again to take it back to my level as not a financial services person, but that is, you have that enhanced ability when you have that enhanced relationship with your bank. Now you can, as a finance director, pick up the phone and just remind your good friends in the banking industry that you're about to have a spike in deposits. But if you are forced to vacate your local bank or the bank with whom you've been doing business for 50 years, and now there goes that relationship. So hopefully this multi-bank pool gives you a comfort level and allows you to maintain those relationships. We've got one more question, this one again from Denise Brown, and I might even be able to answer it. If not, Kevin, I'll ask you, if our bank is not one of the 10 LCR big banks in Georgia, can we find out if it is one of the 184 that would be eligible to participate in the new multi-bank pool? I am thinking I know just enough to know that would be possible. Kevin, can you confirm?
I was trying to think how publicly available that would be. Probably not on the surface as to whether there would be. You've got the issue of whether they're eligible, and then whether or not they choose to participate. The short answer on that would be just talk to your banker and see if they're aware of it and see if they're interested and if that would work for them and be helpful to both of you and the bank. You know, the ratings that we would use as part of the determination whether somebody's eligible or if what their level of pledging would be in that pool is based on public information, but the you know, as you had cited in the slide, SNL is a data company that crunches those numbers and runs it. You know, it's a little bit like a credit scoring type system. Those are subscription based. The treasurer currently maintains a subscription to that. So I don't know that those are. I don't think we're allowed to publish those back out because it's proprietary, even though it is based off public information. So the short answer would be just talk to your bank about it, and of course if they have questions about it, ask them to give me a call. I'll be happy to talk to them also.
Excellent, and thank you for that answer and for that offer, Kevin. All right, I set out on this webinar at 9 a.m. hoping that we could conclude it as well as entertain questions and answers within the scope of 1 hour. We're at 1 hour and 5 minutes. I hope that everyone has had an opportunity to ask any questions that they wanted to ask. If you have additional questions, I would encourage you to send those questions directly to me. I am likely not going to be able to answer them, but I can reach out to the Bankers Association. I can reach out to Kevin and Bo. I can reach out to our legislative director, Clint Mueller, and we certainly can get you and will get you an answer. At this point, if there's, let me ask Kevin and Bo as my co-presenters and panelists. Kevin, Bo, any final words, any final things that you'd like to add before we close this out?
Jeff, I think that you did a great job with the presentation. I just reiterate that that the view that you expressed and that GBA expressed that I also share, and that you know, due to a federal adoption of an international banking standard, it has created an urgency here for those large banks that currently hold 63-65% of the public funds out there, and has created a real crisis. We have to find a solution that works for the large banks, just because, you know, the small community banks can't absorb that kind of displacement of public funds. I think you would wind up in that scenario where having to chop up deposits amongst maybe even dozens of banks trying to find a home for them. And, you know, all banks really need that relationship basis to be profitable and to offer more services. And, you know, just having money that you have to collateralize isn't really what works for them. And, you know, I think currently a lot of community banks may take public deposits just because it's makes good community relations and stuff, maybe not so much that it's really accretive to their earnings stream. So, you know, we do need to find a solution to this pretty quickly, because we can't inundate with community banks. You just don't have the capital base to absorb that much inflow in a short period of time. So I appreciate everybody's patience and understanding today. Again, we were happy to make ourselves available to help answer any questions that anybody has.
Well, Kevin and Bo, let me publicly say thank you to you both. You all have been great allies as we have gone down this road. Kevin, you characterized it as a response to a pending crisis, and I agree. I am, having been involved in this process just over the last couple of months, can unequivocally say that I am thrilled that this coalition has been pulled together. It's people that are on the same page and have similar goals. Having reviewed the legislation, it clearly looks like a viable solution for all involved. To those finance directors and other county staff and personnel that are on the call, we would ask that you do take a look at the legislation. If you have concerns, please share those with us. Please take a few moments, if you will, and review this with any other staff that might have input, certainly with your elected officials. We will be And I'm going to ask you for a quick turnaround on that. If you do have any concerns or questions, try to get those to us within a day or two. I think that on Monday of next week, we will have our weekly conference call with our ACCG Policy Council, and probably during that time, we will be asking them to vote as to whether or not ACCG supports this legislation. I don't see why we wouldn't. But that's why we had today's webinar, so that finance directors could avail their concerns to us. So we encourage you to contact us, reach out by email or phone. For those that might be struggling to print this, I promised you I'd give you my email address. If you can't print it from the handouts pane, I invite you to email me at jchristie, so that's JCHRISTIE at accg.org. So jchristie at accg.org. If you need to contact me, I welcome you to email me. You can call the office. They can run me down. I will be at the Capitol the rest of the day today, but if you have concerns, shoot me an email and I'll be happy to respond. Anything else from if you need to raise your hand, you can click on the hand icon on your control panel. Excuse me. If anybody has anything else they'd like to add, we'll try to recognize those, but I don't see any. I'd like to thank all of you for giving your time this morning to be with us and to help ensure that what we are throwing our support behind is good for Georgia counties across the board. It's always a challenge when you're trying to get consensus representation on behalf of counties as small as 1,400 people to as large as 990,000. But I think this legislation certainly represents an opportunity for us to propose a win-win situation for Georgia counties. So again, if you have anything else that you'd like to communicate with me, please feel free to do so. And thank you again for your time this morning. And we'll look forward to speaking with you each as we continue down the road of this legislative session and into the rest of our ACCG year. Thank you all very much and have a great day.